In the last recording, you were introduced to the reserve market model and its role in the short run. Therefore, it has a connection to the money market graph. You should have the expectation that the AP exam will require you to make those connections. Well, what are those? Let's take a look at how the Fed conducts monetary policy with this new model with ample reserves. In the last recording, we saw that there is a vertical supply curve and a three-pronged demand curve. The first prong or wing of the curve represents the discount rate. I have the term discount rate sitting on the vertical axis slot, but remember, we are dealing with ample reserves. Banks can borrow from each other, and it is based on supply and demand. If a bank decides to borrow from the Fed, it would be at a discount rate. In this model, it represents the maximum rate that banks are willing to pay for funds. Therefore, this prong is flat. The next prong of the demand curve represents the limited reserves. It is downward sloping because as policy rates decrease, the banks will demand more funds because money will be cheaper to access. The last prong of the demand curve represents ample reserves, which was explained in the last recording. Again, it is flat because if the rates are lower, the banks do not benefit from receiving a return. Why? Because at the very bottom of that prong for the banks that participate in the Federal Reserve, it represents the interest on reserve rate. The interest on reserve rate represents the reservation rate, the lowest rate that banks are willing to accept for lending out their funds. For example, if your bank is to offer a special promotion to pay 5% interest on your deposits, you're not going to deposit your money anywhere else paying less than 5%. Therefore, the 5% is your reservation rate. Therefore, for banks, having a policy rate and a discount rate higher than the interest on reserves is not in their best benefit because they will not receive a high return. However, what if the policy rate is lower than the interest on reserve? What banks can do is borrow from each other and place the money in their vaults and earn interest. This practice is known as arbitrage, the simultaneous purchase and sale of funds or goods in order to profit from a difference in price. For example, if a classmate is looking to buy a vinyl record of their favorite band and they are willing to pay $25 for every album that they released in good condition, and you happen to find one at the Goodwill for $5 in good condition, buy it and sell it to your classmate. In essence, you made a $20 profit. This is called arbitrage. Some of you are probably more familiar with the concept of reselling. So if the policy rate is, let's say, 2% and the interest on reserve is 2.5%, then the banks will have made a 0.5% profit. What happens when the Fed engages in monetary policy with ample reserves? The answer would be to administer interest rates, that is, discount rates or interest on reserves. How would this look on the reserve market graph? Let's recall in the last recording, that Jerome Powell announced that he is going to change interest rates. If you recall, that interest rate is the federal funds rate or policy rate. If there is inflation, the Fed would still engage in contractionary monetary policy. If there is a recession, the Fed would still engage in expansionary monetary policy. So let's say there is inflation. How would the Fed chair respond? If your answer is contractionary monetary policy, you are correct. Also, in the last reporting, we have identified the types of monetary policy actions that is conducted with ample reserves. They are open market operations, the discount rate window, and interest on reserves. However, one of these policies will not be applicable. That would be open market operations. Why? Let's take a look at the reserve supply curve. If you notice, it is located in the section of the reserve demand curve that has limited reserves. If you move the reserve supply curve within the limited reserve section, you can observe that there is an effect on the policy rate. Therefore, if we enact contractionary monetary policy by selling bonds and shift the supply reserve curve to the left, you see an increase in the policy rate. This is applicable with the concepts that we have covered earlier with monetary policy prior to 2008. But let's say we have the reserve supply curve in the ample reserve section of the demand curve. If you move the reserve supply curve within the ample reserve section, there will not be a change in any of the interest rates, whether it's policy, discount, or nominal. There will be a change in the quantity of reserves, but not in the rates. For example, back to our original question of wanting to enact contractionary policy. There will be a decrease of reserves, but there will be no effect on policy rates or on the nominal interest rates. This is the difference of limited and ample reserves with open market operations. Open market operations are only used with ample reserves to change the quantity of reserves. Since open market operations is not the most effective policy, let's look at the last two policies, primarily the administered interest rates, the discount rate, and more importantly, the interest on reserves. Unlike open market operations, changes in the administered interest rates will affect nominal interest rates. This is reflected in the money market graph. Again, back to our original example, with the Fed chair announcing to enact contractionary monetary policy. Since this is the action, the Fed will increase administered interest rates. Again, that is to increase the discount rate or interest on reserves. How will this look on the reserve market model? You would simply draw a line that shows the direction of the increased rates. In our example, both rates are increasing. Therefore, the flat prong or wings of the discount and ample reserve section demand curve would be drawn up. It would also work in the reverse. If the Fed wanted to engage in expansionary monetary policy, they would decrease administered interest rates. You would draw a line at the flat prongs or wings of the discount and ample reserve section of the demand curve. From there, you can draw your outcomes on a money market graph Based on the change on administered interest rates, you will be able to determine the outcome on the nominal interest rate and the overall economy in the short run.